everybody. Welcome to Mortgage Pros 411. I am Audrey Boissonou with my co-host Kevin Casey, and we are so lucky to have Dr. Lawrence Yun, who is the Chief Economist for the National Association of Realtors, joining us today. Welcome, Lawrence. It's so good to see you. Thank you for being here.
Hello, Audrey. Hello, Kevin. Happy to join.
And thank you for
Yeah,
coming.
we really appreciate it. So there are a couple things coming up. NAM Legislative Conference will be happening in April, and we will get into that later, but we have a limited amount of time with Dr. Yoon, so we want to get to it. So there is enough to talk about that we could go till Thursday. So let's just start with the elephant in the room, which is Silicon Valley Bank failing, and they weren't the only ones. Sovereign and Silvergate also failed, although my understanding is those are crypto banks. So maybe you could help us understand the difference and what impact that is having currently.
One impact that is happening, outside of the Silicon Valley, is that the home buyers across America are suddenly waking up to little lower mortgage rates because mortgage rate right before the downfall of the Silicon Valley Bank was essentially at 7% or a little bit above.
Yep.
Yesterday, it was trending down towards 6.5%. I know it crept up a little bit this morning, but one impact for the broader rest of the country is lower mortgage rate, and we know that mortgage rate is the principal driver of the home buying activity. I mean, it's not going to go back to 3% condition, but it's going to open up the gate a bit, and some people who got priced out at 7% begin to say, well, can I be priced in at 6.5%? So that is a good news for the market. But of course, in the Silicon Valley, it is a terrible news, not only about the fear of is people going to receive all their deposit back above the FDIC legal amount, which according to, it looks like most people will get it back without a haircut. But the other element is technology sector. There was already weakness in the tech sector. Facebook, Google, they were announcing layoffs, and all the startups, all the small companies who you are being run by formal, Google, Facebook employees who went on their own. Now they don't have the capital, so they cannot expand their business, which means that job growth potential in the Bay Area would be sharply cut. So it's a very localized event in terms of the market, the housing market, where the Bay Area, I think, will get a negative hit, while the rest of the country will, in a sense, somewhat benefit from the lower mortgage rates.
And the other thing with the Bay Area is a lot of our loans are jumbo loans, and all these little regional banks that are going down or are tightening. If they're not going down, they're tightening their lending right now. And those are the lenders that we typically go to when we're trying to finance a $2 million home. Because performing loan limits just don't do it for us here in
Well, I received at least 3 emails from First Republic Bank in the first 2 days of this saying, everything's fine, don't worry, everything's fine, everything's good, right? Kevin, you got them too, didn't you?
I got the same ones, yeah.
Yeah,
I got an email from him before, but suddenly I got 3 over the weekend. I'm like, oh, something's not good.
Yeah, exactly. So it's interesting because initially the regional banks really took their stock, took huge hits. Now they're coming back because there is a backstop by the Fed, right? So,
Yeah.
So why don't we talk about that for a minute? What is the Fed doing to help the situation?
Fed is the lender of last resort. So assuming that the banking system or specific bank is healthy, other than the potential bank run. Bank run is a case where all the banks, they don't have enough money in the bank to satisfy all the depositors. So all the depositor shows up at the door and say, give me my money. Well, the banks would have to shut down. They don't have the money. It's simple as that, independent of how profitable or how future profit may be. So bank run is a different animal. And then essentially the Federal Reserve is essentially saying to the regional bank, we will provide the lending support. We will possibly re-examine some of their balance sheet to assure that the risk profile is not too much. Because certainly in a free market system, anytime a business manager makes bad decisions, say taking on too much risk, and business goes down, well, tough luck. There are many other businesses, many other banks who run better businesses or better manage their risk. Well, they can begin to take a larger market share as the one bank fails. But I think in this case, with Silicon Valley Bank being so large, so important, and auditors were indicating that they were healthy right before the bank run. But they had a mismatch. The risk was really the mismatch in duration where Fed raised interest rates, which everyone is familiar with. Therefore, the banks need to offer 4%, 5% to draw those depositors. Yet the rate of return, what they had invested, is only providing 2% return, treasury return. So you pay 4% to depositors, you get 2% return on your investment. Well, that's not a sustainable business model. And that's where the Silicon Valley Bank really is suffering. And I think this is where other, the scrutiny on other regional banks is occurring to say, is the balance sheet of the other regional banks something similar to Silicon Valley? Then, of course, it's going to be similar results.
Well, so just to back up for a minute. So Silicon Valley Bank was number 16 in the country, I believe based on deposits, right? They're number 16. They went through an audit 2 weeks before this happened and were given, and I quote, a clean bill of health. And so that is definitely disturbing in the sense that what are the auditors looking at? What are they seeing? And how are they coming up with everything's fine when it's not fine? And to your point, as far as, so one of the issues that I understand, and maybe you could help make sure that A, I'm saying it right, and B, expound upon it so that they really get the real picture is, so let's say, so as far as what a bank has to state their assets are, they're showing, like, let's say they own, $1 billion in mortgage-backed securities or treasuries or whatever. That was the face value, but the market value has now decreased, which is what's happened in the last year. That's the issue, right? So it looks like they're okay, but the reality is if they have to liquidate those assets, then they're going to be short. Is that correct?
Yes. So what Silicon Valley Bank was doing was all the deposit they had, they invested in the safest asset in the world, which is U.S. Treasury, and the mortgage-backed security, which has government guarantees. So you would think, oh, these are very, very safe. But if it's providing only 2% interest rate, and now somehow the interest rate is much higher, well, if you want to sell that product to say, okay, who wants this government bond? It pays 2%. Well, no one is willing to pay the face value, given that alternative is 4 or 5% that people could get. So only way to offer it is greatly reduce the price so that, say a 2% return then becomes 4% return with the reduction in prices. So as the Silicon Valley Bank was forced to sell some product to meet the depositors' need, well, they're, again, recording losses after losses and losses, and suddenly it became a bank run.
Yeah,
Right, exactly. And the bank runs these days, it's not like, the old days where you had to go to the bank, line up, and hope to God you got in. This is all being done electronically, so it can happen very swiftly and with very little warning. Although, again, even days prior to this happening, it was, the bank was stating, oh, everything's fine. The auditors are saying everything's fine. So I think that, the big, huge issue is we're not getting good information out of the people who should be providing good information. How do we fix that? Any ideas?
The auditors, should be looking at all the lines very carefully. Obviously, when they looked at it and gave a clean bill of health, that clearly was a mistake, and I think they need to look at how they need to re-examine. What are the auditors' role? Why did they get it wrong? And if so, what is the necessary course to assure that this type of mis-auditing does not occur again? But as the Federal Reserve is providing that backstop to other regional banks, I think the question then becomes, okay, what if another bank begins to fail? Well, people get their deposit back. However, where is the money coming from? Eventually it's the taxpayers' money, or if it's FDIC, then FDIC has to raise the premium on all the deposit, which means that ordinary consumers out in Indiana, out in Florida, begins to pay a little more for all the bank fees because FDIC has to recover. So in a sense, this is the moral hazard where you are saying, okay, once you have the government guarantee, you should be careful. You have the FDIC guarantee, but once they go under, it almost seems like if their business model turn well, they get big bonuses. If their business model fails, well, let's hit those people in Indiana and Florida with extra FDIC premiums, which again, doesn't
But at the
certainly
same
doesn't
time,
sound fair.
for the FDIC, it's almost a business decision because if they let Silicon Valley depositors go that aren't or over the $250,000 limit, and with Silicon Valley, there's a lot of them because there are a lot of payroll companies going through there, like dollars each week. If they let Silicon Valley go, then that would trigger more banks that would actually cause them more losses. So in some ways, the FDIC is smart to step up and say, listen, we'll honor all deposits with Silicon Valley because it stems the surprise and it stops the further calls on other banks, hopefully.
Yeah. Ideally, that would be the case. Or even better ideal condition would be they find another bank, larger size bank, much better managed, to say, do you want to take over Silicon Valley Bank? And once that happens, the customers, they don't see any difference other than the change of name. And the other bank who acquires Silicon Valley, perhaps the government offers at a discount because right now government is owning the bank and is wiping away the shareholders or people who are in the management of the Silicon Valley Bank. So the most quickest response or best outcome would have been where they find another bank to say, okay, go ahead and take it over. I know Elon Musk considered it. I don't know what was happening behind the scene related to that. But anyway, for the real estate market, mortgage market, at least the good news is that the mortgage rates are lower related to this events. And for most home buyers, they're just looking at their mortgage rates. Can I get in the market? Can I not? And 40 basis point lower, maybe some people can now consider coming back into the market.
No,
Well,
but
my conversations over the weekend with somebody who was involved in the talks about whether, who was going to acquire them or if someone would acquire them, all the East Coast banks said no. And there was the Silicon Valley Bank did business very differently than a lot of banks. And so some of the bigger banks who were looking at it were like, no way, because they don't want that business model. They can't handle it. And so even if they were acquired by some other bank and their regulations were imposed on Silicon Valley Bank, it's going to change the face of that bank no matter what. So the way they were structuring loans, et cetera, and doing business loans, et cetera, was very different than what is done in other places. So I think it's going to be interesting to see what happens with that.
Yeah.
Sorry, Kevin, go ahead.
What I'm also seeing though is a lot of the banks now are selling off their mortgage-backed securities that they have because they want to liquidate. And if you are a company that acquires mortgage-backed securities, you either can do a new loan or you can acquire one that already has a track record and has only got a low interest rate at 2.5%, but you're going to get it at where it's paying current market because you're going to buy it at a discount. And it seems to me that a lot of the banks right now, Silicon Valley's got to dump all theirs, but a lot of banks right now are dumping their mortgage-backed securities to liquidate, so they're ready for a run on the bank. And if you were a bank or mortgage company, you're actually better off buying these existing mortgages at discount than putting out new money for new mortgages. Do you see that kind of hurting the market going forward? Because we're seeing a lot of our jumbo lenders disappear, especially here in the Bay Area. We've lost several of the main jumbo lenders.
Well, when you say that, though, you're talking about some of these regional banks who have either been acquired by someone else and now they're part of a bigger organization, or they've stopped lending. It was prior to this. It had nothing to do with
it. But we're also seeing it's like won't mention names, but some of the regional banks in the area, their pricing is going to have to go higher. And they were very competitive right now. In fact, they were so competitive, it was really hard for mortgage brokers to beat them on the market. And now I think what's going to happen is their pricing is going to go up and the independent mortgage people will have a better shot of going head to head against the banks, even the bigger banks.
Obviously, some regional banks who are in some, trouble on the edge, maybe they have to sell. And as Kevin mentioned, maybe there is some degree of selling going on. But the broader market, obviously, there are buyers. They are saying, well, these are government guarantees. So even if it's, Veterans Affairs mortgages, FHA mortgages, or, mortgages originated by banks but eventually get sold to Fannie and Freddie, government guarantee. So from the investors, the mortgage investors' point of view, if there's a discount, they say, yeah, I want to grab it. So there is a broader liquidity occurring because of this event, even though individual bank, due to the liquidity issue, they may be forced to sell.
So overall, the impact of these failures on the mortgage markets are what? Other than we're getting better rates, is it going to? We're hearing things like there was an article, or Rob Chrisman wrote an article yesterday about margin calls being a thing these days. And so, are we back to some of the liquidity issues of 2020? Are we going to be able to avert that? What are your thoughts on that?
Today the Treasury bill was around 3.5%. Right. So under normal circumstances, the spread between the 10-year Treasury and the mortgage rate should be only about 200 basis point, or very specifically 170 basis point historical average. But right now it's 300 basis point spread. So obviously this, some of the liquidity friction that is out there with the mortgage market, or people perceive that even though it is an implied government guarantee on mortgages or mortgage-backed securities, it's implied. It's not 100% government guarantee. So there is a little wider than normal. In fact, this wider than normal spread, at least in modern times, it occurred on two other occurrences. One was when Lehman Brothers went under back in 2008, the spread widened. And the second time was when we had COVID arrive in March 2020. So great uncertainty. But eventually, those spreads disappear after about 8 months, 10 months, 12 months. So if the spread disappear, we could actually see mortgage rate going under 6%, say by towards the year end.
Take a moment, breathe, and pray for that. Okay, that'd be nice. Because last week, rates had headed down a little bit recently, and mortgage applications went up, immediately. Even refinance applications, which are still way, way, way down, those went up a little bit. So we know that rates matter. And so here's the question: how long will this happen? How long will the rates stay down, or can they, or is this just a blip on the screen? Or do we still have another few months of holy moly in front of us?
I think a couple of months of holy moly is always a good forecast because one really doesn't know what's going to happen over the next couple of months. But I would say that by year end, it will be lower. I think the peak in mortgage rate has already occurred. We hit that 7% mark in early November. We again hit the 7% mark just a few weeks ago. So they're trying to do that testing of the top points, and they tested. And then I think the market is not unable to surpass that, and it will not surpass for the simple reason that consumer price inflation is calming down. Maybe a little stubbornly, not decelerating to the degree that Federal Reserve would like to see. But, consumer price inflation was 9% several months ago, then 8%, 7%, and this morning 6%. So it still is trending in the right direction.
Okay, so with the Fed meeting next week, what should we be expecting? So there was a 50 basis points hike baked into the market prior to the last couple of days. Now the forecasts are either for 25 basis points or no basis points, which is hard to imagine based on Jerome Powell's comments last week. So what do you think for next week? What are we looking at?
I think 25 basis point, which is less than the 50 basis point, which I think they would have done. And I think they're doing 25 basis point, not in terms of the real impact to the market, but they want to signal to the broader world that they are concerned about inflation, and we will not let inflation get out of control. So it's more of a signaling device, even in face of some of the regional banks, being very wobbly, just to signal that inflation is still our primary concern. And their charter for the Federal Reserve is not to protect the banks, but to ensure that inflation remains stable. So they would need to follow their mandate, and therefore they want to signal by raising their Fed funds by 25 basis points. And depending on how everything else plays out for the next 6 weeks, then another quarter point rate increase is possible, but that is it, I think. And the key reason is steadily inflation number will improve and improve, meaning lower inflation, because right now, this morning, one of the bad component of the consumer price inflation was rents. Rents are still accelerating. It is rising very fast, but the apartment sector is indicating rents are not rising. So the Federal Reserve, which computes apartment rents along with single family rentals, and exactly, I'm not sure what all the other sampling is done, but private sector data on apartment is saying that there is now overabundance of new rental units being completed, coming onto the market, and rent increases are not occurring. And assuming that the consumer price inflations follow this trend, the overall consumer price inflation will be much calmer towards the year end.
Yeah, well, we're hearing, if you listen to Barry Habib at all, they're saying by May that those numbers should be moderating even more and be a little more accommodating in terms of being good for us, right? So yeah, so CPI came out, headline was up 0.4, core was up 0.5, but headline went from 6.4 to 6, as you said, and core went from 5.6 to 5.5. So they were hoping core would be a little less, but again, you've got shelter costs at 43% of CPI, which is a humongous number. And then, so as all of that starts to moderate, and it sounds like that's, as they keep saying, looking in the rearview mirror versus what's happening real time right now and going forward. So it takes itself a while to work itself out. Yeah. I keep rolling my eyes at myself because I can't seem to
You are
formulate
absolutely correct.
a complete thought. So it's and then we have CoreLogic's home price index that came out, and we're still looking good as far as values go overall. So obviously we had to moderate from 30% appreciation, which is ridiculous, to something less. So it looks bad as it's happening, but it's good for our market overall, right? We want these prices we don't want that kind of appreciation. We want moderate appreciation over time, but something
you wanted, if you bought the house yesterday, you want the 30%.
Well,
right
you do, but the average person with a break. Oh, excuse me. Sorry, I didn't mean that. Okay, so Dr. Yun. So as far as appreciation goes going forward, and we know that it is very geographic from one part of the country to the next, but just overall, what is your thought over the next year as far as what we're looking at as far as values, et cetera?
Home values from 2019, pre-COVID, until through last year. Remember, last year home sales were falling, but not necessarily home prices. Home prices were still rising, even as with the exception of maybe San Francisco was experiencing some price decline last year. And now, in the latest information, San Francisco is showing about 15% lower price compared to the peak. But outside of that, this special exception, nationwide, prices are still rising about 2% from the prior 12 months period. But with mortgage rate being what it is, with the buyers having retreated, I think the home prices will be roughly equal this year compared to last year, meaning no meaningful change, either up or down. Maybe some southern cities where there is affordability and strong job creation, say like Atlanta, Jacksonville, Florida, maybe they will continue to crank out gains, 5% gains. But once you have this mismatch in growth of home prices and income, home prices rising 30%, well, people's income did not rise 30%. That's a mismatch. So we need to allow income to begin to catch up with home prices sort of stabilizing.
I thought it was interesting because during the pandemic, there was such a lot of talk about this huge exodus out of some of these states. And California was the one that was mentioned the most. But interestingly, I read 18 US states experienced a drop in 2022, with California coming in 10th highest at 0.3%. Now, 0.3% of 40 million people is not a tiny amount, but we're also hearing stories about people coming back. So my clients were offering on a place in Long Beach the other day there were 5 other offers. I mean, and it's going for way over asking. So it is interesting out there. And I think
that we're still seeing even
we're
in San
seeing
Francisco,
over
it's
asking in
tight.
the Bay Area as well, all over California. And so it just depends on how is
But
it marketed,
it's 5 offers. It's not 25 offers.
or 50, and it's
Yeah.
maybe 20 grand over asking, not 500,000. I mean, and it does matter. Like, is it priced well? Does it show well? All those things matter. Did your buyer listen to the realtor and follow the directions they were given?
And
If
how
not,
good did the realtor do showing the house, and all that goes into it, how good they presented it. But if it's presented well and the realtor did their job, it's going over still.
yeah, it's because there's not enough inventory, right? I mean, that's just the name of the game right now.
Absolutely.
So let's talk about inventory for a minute. What are your thoughts on that? Like, going into the spring buying season, like it's March, so we're not seeing tons of places, hit the market. What are we looking for or looking at coming up in the next few months?
Yeah, inventory. It's interesting that all the data is showing that home sales are much lower than before. In some areas like California, maybe 45% lower now compared to just 12 months ago. So much lower activity, yet multiple offers are happening. So why is multiple offers happening when the buyers retreated? Because there's not enough inventory. So if someone is focused on certain neighborhood and they're looking for the inventory, they see only one. And they say, no, that's not the one. So they're waiting and waiting for the fresh listing to come out. And when a fresh listing pops out, they said, okay, I'm going to make a bid. But then there are 3 other families thinking the same thing. And consequently, even though we have far fewer buyers in the market because of higher mortgage rate, the limited inventory is leading still to some degree of multiple offers, depending upon how it is priced, the type of neighborhood, and the price points. The luxury end, we are seeing much greater increase in inventory, but on the more affordable price range, inventory shows up, it's been grabbed quickly.
Right. So we heard from a guest a few months ago that MLS searches were off the charts. Like, there was all this pent up demand there that people were watching, and we were thinking they were watching, waiting for this big crash to come that wasn't coming, right? So it took a while to get through that. There was this expectation, oh my gosh, here we go. It's going to be 2008. We're going to get a great deal. We just have to wait for it. I think people are starting to understand that is not the case. Would you agree with that? I mean, that is not happening.
So I think the consumers need to understand the factual difference now versus what happened in 2008. One factual difference is that lack of supply. We had an overabundance of supply back then. Builders were building right and left, but the builders have been very restrained in the past 10 years. And in fact, we had a housing shortage pre-COVID, and the housing shortage was exacerbated during the COVID real estate boom. So we still have that residual housing shortage. So inventory is one major difference. Second major difference is the lending criteria. Back then, subprime lending, risky mortgages, which simply imploded with those teaser rate, no income documentation. Today, we know that people who took a mortgage, they had to meet much tougher standards. So people who are homeowners with mortgage, they are of that very solid financial foundation. So fundamentally different market condition. So is it going to repeat just like what happened in 2008? Well, too much of a fundamental difference. And maybe the third difference. Back then, there was a job cuts, net job cuts. This time, we see job cuts in the mortgage industry. We see job cuts at Google, Facebook, Amazon. Yet there's still job creation, such that job creation is much larger than job cuts. So we are in a job creating environment.
Yeah, I mean, there's so many reasons it's different than 2008. We have covered that ad nauseum for the last couple of years. And so it's important that we keep beating that drum and conveying that message to the consumer and to the realtors. And here are the reasons that we are in a different place. Because realtors that we're talking to are freaked out too. They have been. And so they need to have this information. They need to be reassured about the market so that they're able to educate their borrowers and their clients accordingly. So on that note, so what training opportunities do you think your membership needs? I mean, are they aware of everything that's going on in the market? Are they aware of all the agency changes? is there something that we as LOs can do to help them understand what's going on? Any suggestions for that?
One realtor came up to me to say that I'm fairly a new agent, and I heard about short sales during the last foreclosure crisis. Should I take a short sales course and be certified in short sales specialty? And I said, well, right now the number of distressed property sales is 1% of the market. Back then, it was 1/3 of the market.
Wow.
So is it going to rise? And I said no, because homeowners are so happy having locked in those 3% rate. They're
Yep.
not losing jobs for the mostly. We know that individual cases they are, but nationwide there's still net job creation. So the short sales, no, I don't think you need to learn that. But you could focus on different things. One of the things that NAR is very focused on is on two areas. One is commitment to excellence. We call it, or realtors will recognize, C2EX, commitment to excellence. And that is essentially to say, look, in order to make the real estate market very healthy, one has to also participate in the association matters. The numbers count. More realtors begin to make noises to the elected officials about, say, zoning rules, or how bad the rent controls are, or the importance of 1031 exchange. That's all important for the real estate market. So commitment to excellence is one course that it's not a mandate, but we strongly encourage realtors to take. And the second part is we call the fair haven training, essentially to say that we may not recognize, especially people who are not in the minority groups, that there could be certain implicit bias that we are unaware of. So just having at least the understanding of what, say, minority communities may be undergoing in the home buying or home selling process, we can better serve the clients that way.
Absolutely. So again, LOs can interact with realtors, and I would love to see more collaboration between trade groups in the industry, between NAM and MBA and NAR, and we're working together and coming together, because most of the time our objectives are very similar.
Very
and
similar.
and the fact that we're all operating independent of each other just has never made a whole lot of sense to me. I mean,
we go to DC every year with the National Association of Mortgage Brokers, and we see NAR there, like they're either a week before, a week after us. MBAs they're a week before, a week after us, and generally we're all talking about the same deals. And it'd be nice if we all kind of got on the same page and coordinate together. But yeah, but I 100% agree. Go represent your association. Really important.
Right. You can't just dial it in anymore. I mean, the days of just sitting at your desk and loans falling out of the sky, or just sitting at your desk and thinking, oh, I know how to do a loan, it's all the same. It's not the same. Everything is changing at a pace that is unbelievable. And it's interesting because there was this idea a few years ago, and we saw it in the real estate sector and mortgage, where you have people, promoting the idea that, oh, you can just push a button to get a mortgage. Oh, you can just push a button and sell a house or buy a house. And it's really important that we continue to let the consumer understand that they need us on both ends. Like, buying a house or selling a house without a realtor, are you insane? Like, I have a real estate license, for God's sake. I have never, ever handled my own transaction because I don't do it every day. I'm not an expert realtor. Like, you know what I mean? So if I have a license, and I don't think I'm qualified, then who does the average consumer think they are, that they can navigate that process, right? But with that being said, if you're a realtor, if you're a loan officer, you better be up in your game and making sure that you are bringing value and you aren't just dialing it in. So it is education, 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 as far as I'm concerned. Thoughts on that?
What are you saying with the iBuyers in that realm?
Well, definitely in terms of being knowledgeable, how best to serve their clients. Everyone has their business models. Some of the business model is to be updated on everything. The market changes, to be updated on education. So you see, realtor service is not all equal. In fact, say in markets like Aspen, Colorado, super wealthy market where there could be Hollywood people who are purchasing. So I asked, how much is your cash transaction in Aspen? And they said it's huge, huge. So you think, well, maybe mortgages are not important. But when I look at the numbers, what I find is that Aspen is more sensitive to mortgage rate changes than other markets. So
wow.
when I talk to individual mortgage brokers, they say, it looks as all cash on MLS data, but in reality, there's a lot of borrowing to make it an all cash transaction.
Right.
So people who are very astute in how to serve their clients, they will serve in the way to make that transaction complete in the best way. And it's a good thing that we take survey of home buyers, home sellers, recent home buyers, recent home sellers, and ask, were you satisfied with the realtor service? And they said about 80% of the respondents said, yes, I am so satisfied. I would recommend my family members, my business colleagues, my friends to my realtor. But then they add this, not the other realtor, my realtor, they said they would recommend, which implied that not all realtors are equal. Some are more knowledgeable, some are getting that extra business acumen. So people have to really look for that recommendation.
Yeah,
Well, I think
go ahead, Audrey.
I was just going to say, I think that we have seen that historically as well, where you have some of these LOs who have set up these monster machines where they are cranking through, I mean, incredible numbers of loans. But the question becomes, are you doing that because you're so systematized that you're just, your borrower comes in and says, I want X. Okay, you just give them X. But what if Y is better for them, right? What if there's another strategy or alternative that should be considered? If you're not offering that to your borrower, shame on you. Like if your process doesn't allow for the individual situation of your borrower or your client, that's not okay, in my opinion. So I think that, again, as we move forward, we really need to stay focused on the borrower. And I think that gets lost with a lot of this technology because lenders and investors get into this for the money. And it shouldn't be all about how much money did I make. And those numbers, and by the way, the GSEs too, look at the money they're making. It's unbelievable. And so this is all on the back of the homeowners. All the while we're talking about affordable housing, and the borrower gets lost in all this. And it makes me crazy. It should be about the client, about the borrower. What do you need? What is good for you? Not just, you need to make a profit 100%. I'm not saying 100% profit just for the record. I'm saying for sure. And so, but where is the middle ground of, okay, your profit margin and the borrower getting the best deal they can get, right? So
Yeah. I mean, like FHA mortgages, I mean, they exist. It was created to serve the first-time buyers. So, essentially people who need a little additional help in terms of the, lower down payment requirement. But there's people pay the FHA premium for the excess for their lower down payment. But if the premium is excessively high, then it just makes the cost of home ownership much more difficult. And premium was high. How do you know that? Where the FHA reserve fund was way, way beyond what the legal requirement was. So we were constantly showing the accounting book of the FHA to HUD to say, look, it looks like you have way, way too much money. Maybe your mission is to get the first-time buyers in by reducing to manageable levels. Of course, we don't want to risk any taxpayer situation, but still, with so much excessive reserve, maybe you have a room to reduce the premium. And thank goodness, recently it was announced that they will reduce. But same thing for GSE. There's very little default currently, and consequently, the GSE, meaning Fannie and Freddie, are raking it in. Maybe some of that, they realize, well, we exist not to maximize profit, but we exist to provide home ownership opportunity, and therefore maybe we could reduce some of the G fees, guarantee fees for the home buyers.
Yeah, we're hearing zero about that, aren't we? Like it is, I mean, FHA seems to be looking at that. I mean, we just applaud their, lowering the MIP and the MI, and they are looking forward. They just finalized and made permanent a 40-year option for a modification. That's great. But I have concerns about the GSEs and the direction that they seem to be going. And so hopefully they'll start listening. So it sounds like you're involved in some of those conversations, Lawrence. Are you with the agencies?
Our members are very active. Our members hear some of the stories that's happening on the ground, and then it filters up. They just mention to NAR leadership, NAR president, and the NAR president would say to the staff, "Hey, look, I hear this from the ground. Can you talk to the member of Congress of what's actually happening?" And certainly we look at all the angles. Often with any tax reform discussion, there's always discussion about taking away 1031 exchange. Then we have to educate the congressional staff why it is so important for the economy. I think one issue that really needs to be considered right now is that capital gains tax exemption on a sellable home, especially for people in California. I mean, they have a single person who purchased a property in San Francisco 10 years ago. They would have easily exceeded that $250,000 capital gains exclusion.
Absolutely.
Because of that, they don't want to move. Well, and if people don't move to the desire, say, for better commute to business or for better, closer to the family members, whatever it is, you are hindering that. And many people just don't like the fact that they sell a home and they have to pay Uncle Sam a large amount. So I think at the minimum, we should have indexed it along with inflation. So, consumer price inflation today 6%. Well, why don't we index the capital gains exclusion to 6%? Because most people's wages are indexed, Social Security benefits are indexed. So why not the capital gains exemption amount?
That's a great idea. I mean, I talk to people all over the country who they can't afford to move. Like they're older, they'd love to downsize, or maybe they want a one-story house or, right? But they can't because it's too expensive to sell, pay the taxes. What they're buying is more expensive. Like it just doesn't pencil out. And so they stay where they are. So again, if you want to solve some of these problems, we got to do something outside of the box. Kevin, were you going to say something?
No, it's exactly it, because it's not just that. It's like if you have a house, and I have one in San Francisco, and if I went to sell it, now my property taxes are reassessed up to current price versus, I've got a nice low tax rate. I've got to pay that capital gains. It's like, no, it's better just to hold on to the property, and then that keeps that house off the market for the future.
So, Dr. Yun, are you hearing anything around the country? I had concerns when the values started going through the roof for the states that didn't have a Prop 13 equivalent, and I've actually heard a few things about people like in Florida who get their property tax bill and now they're like, holy moly, what do I do? Because it's gone up a lot. So is that being addressed nationally at all?
The rising in home values has two angles. One is homeowners feel much wealthier because if they were to sell their home, they're getting much higher value, and we have seen a quite sizable gain. But most homeowners are not in the market to buy or sell. They're just living in because they have kids to go attend to school and the normal thing. But then the tax bill arrives, which say, you owe much more than before. So you begin to wonder, well, given the overall consumer price inflation, I see that you have to pay the teachers a little more, maybe the police officers a little more, or purchasing some of the government building will cost a little more. But is it as increased to the level of home price increases or overall CPI? And I think what's happening is that property taxes are rising much beyond the CPI. And this is, the purpose of government, again, is to provide a service. But it's not to just rake it in just because they have that opportunity.
Yeah. So, I mean, we're hearing from Europe as their central banks are raising their interest rates. They're not on fixed rates, most of them. They're on adjustables. And so if their central rate bank raises the rates, their mortgage rate goes up, and they're not able to afford their houses right now. So we're lucky that we have a lot of 30-year fixed mortgages or fixed rate mortgages in this country, but the property tax is a variable that we got to keep an eye on because it's an issue. And, and so someone might be able to sell their house, but are they going to be able to go rent for less? A lot of times the answer is no. And so, again, it's very complicated. And how much government involvement do you want, et cetera, et cetera? Complicated. I get it. Another pressing issue is flood insurance. and the increasing premiums on flood insurance that are happening. And I think that this is catching a lot of people off guard, especially if it's not something they deal with every day. And so what is NAR's, what are you guys doing as far as flood insurance goes?
Not only flood insurance, but say like the wildfire, people who are
I know.
living near, say, Yosemite Park, suddenly there was some wildfire. So,
Yes.
but it could be just one-off type of event. But, from the actuarial basis, they can say, well, we think this was systemic, meaning that it's going to repeat again and again. So we have to price that into it. So, of course, with any insurance, it should be actuarially sound. The premium should reflect the fact that there is some risk associated with it. But at the same time, one cannot simply say to a homeowner, possibly who has already retired, a pensioner, living along, home they have always lived for 20 years. We're going to raise your flood insurance by $8,000 this year. They don't have the money. Only way to get out of that is to sell their property. So they are selling because of such a sharp increase in flood insurance. So any increases, I think, should be done with the proper expectation, meaning that, yes, we need to get it up to the actuarially fair value, but do it in certain increments and not at all at once, which, force people to sell their property just to get out of that situation. And of course, anything that is repetitive flooding or repetitive exposure to risk, they should pay higher premium for those exposure to repetitive risk.
I saw that there is a proposal that that they changed the model to the point where there is some sort of fund that every homeowner pays into, which if it's every homeowner, it's going to be every renter too, because those costs trickle down, whether the landlord's paying it or the homeowner's paying it. So everyone is going to feed into some fund that will go for natural disasters, I guess, overall. So I don't know. It's going to be interesting to see all of this play itself out, but it is a huge issue, especially with the natural disasters, the cost of everything. It's just crazy out there. So,
Let me also just go into the one big issue before I have to jump off because I have another event
yep,
at the top of the hour, so I have to make this. I
yes.
think the overall for the country is we have a housing shortage. We really do. And, some people talk about how do we address it. But the ultimate answer is if we have a larger population, we need more housing. And we also need to account for some of the very old property that needs to be demolished and rebuilt. So we just need more housing, and that will address some of the housing affordability issues, the access to housing. I think the solution is not to say, okay, young adults, move in with your parents, or or buy a much smaller size home. People like to have backyard, so I think we need to accommodate people's preference of it, and only way to realize that the dreams that many Americans have of owning a property is to ensure that we have adequate supply and we are still in that housing shortage.
Yeah, it's a tough one. I thought it was interesting. I saw an article about 75 that the headline was 75% of Americans who moved last year have regrets. Isn't that's a crazy number? But the top four were the top 80%. Actually, it's almost it. So 20% wish they'd gone to a bigger place, 20% miss their old place, and then it got into reasons that I thought were kind of stupid. Like, I wish I'd gotten rid of more stuff. Like, who cares, really? It was too much of a hassle. Get over it. You're moving. It's going to be what it is, right? But I thought that I wish I'd gone to a bigger place. I miss my old home. They were big numbers. So it's, we want to make sure we're taking care of our borrowers. We're listening to their needs. And I think in the last few years, a lot of people have bought places because they felt desperate. They thought they had to get in somehow. They made a lot of compromises. There was a lot of push on both ends, and there you go. So we're going to keep going. I know you have to leave. You've gone over what you had told me you had available in terms of time. We're so grateful for your input and your help, and we will look forward to seeing you back again sometime soon. Thank you so much, Dr. Yun.
Enjoy that. Take care.
Thank you. Thank you so much. All right, guys, we're going to keep going. And I thought I saw in a headline that I thought was fascinating. So we've just seen 3 banks fail and we are all freaking out, right? Do you know that in the country, only 55% of deposits are insured? I did not know this. And also, since between 2000 and 2023, 565 banks have failed. I thought that was fascinating. So I think that, again, this has been telling because it was the number 16 bank in the country, and they had just gone through an audit, et cetera, et cetera. But it's not, it happens.
There's no
This stuff
simple
happens.
answer. There's no simple answer because a lot of people, oh, well, we need more regulation. But see, the big banks, they love regulation because that wipes out their competitors because they can't afford the regulations.
Well,
And one of the things I have found from, my experiences in other countries and banking and how that is, there's only 6 banks in Canada. There's only 4 in Finland, and that's it. We have, how many banks just in Northern California? It's, more than that. And I think the United States works better because there's so much competition and new innovations coming through, including in banking. And that's important. And so if you have too much regulations on them, then you stymie that. And having, a small bank go down is not the end of the world. Having the problem with Silicon Valley was it was a bigger bank. And the other problem with them is, people, oh, who cares if these companies, they have over $250,000. Well, that's someone's payroll that.
right. It's the
You know,
payrolls. I mean, it's the operating
I mean, I had to
dollars.
deal with it personally because, on the side, I am president of board of a charity, and we had to deal with charity payroll this week, and it was through one of the banks that's been in the news. And we're like, okay, do we not put that money there and make a payroll? Do we have to get another bank account so we can, and you can only have so many bank accounts. It gets too unruly. What was it? One of the big companies, and they were saying like they have a $50 million payroll that you can't just put that into an insured account. It doesn't work. Maybe the FDIC needs to insure payroll accounts separately, or I don't know what the answer is, but
I don't either. And can you insure everything? I mean, that you can't, right? And again, it's telling. So I was okay. So we went from $100,000 of insured deposit to 250, which is a drop in the bucket for these companies. It's literally nothing. You can't divide it amongst a ton of different accounts. And again, if we only have 55% of our accounts insured right now, it's crazy. I just wanted to briefly talk about the NAM conference that's coming up. Do not hang up right now because this matters. So they have quite a lineup for us. April 14th through the 18th in Washington, D.C. The first day is education. You can do a certification class. Then you have different speakers and leadership. And then you have lobbying on the 17th and 18th. So they have the chairman on the House Committee on Financial Services, Representative Patrick McHenry. He will be speaking. The Honorable Marcia Fudge, Secretary of the U.S. Department of Housing and Urban Development. We have the Honorable Sandra Thompson, the Director of FHFA. I'm looking forward to that.
Yeah.
It was interesting listening to her last year. She was acting director at that point. Now she is the director, and she has made some pretty significant changes that most of us were not expecting. And so it'll be interesting to hear from her. We've got Representative Warren Davison, who is the chair of the Housing and Insurance Subcommittee, House Committee on Financial Services. He's speaking, and Richie Torres, representative. He's the House Committee on Financial Services. So again, these are things that impact us, and we need to be involved in that. In other news, and Kevin had mentioned this first, and then I saw that NAM has, I think it's a call to action. So we'll track that down and get it posted. But I've been pushing them to put these calls to action on their homepage, so nam.org. But there is the CFPB is reviewing Reg Z's mortgage loan originator rules pursuant to the Regulatory Flexibility Act. They want to hear from us. So we're going to take a little dive into that.
Wait, say that again. The CFPB wants to hear from us.
I know.
Not just you and me, Audrey. It means everybody listening on the show right now.
I know. Crazy. But they do ask for our input periodically. And often they only hear from like the big banks or the big, you know what I mean? The big guys.
Yeah.
They don't hear from us, and they need to hear from us. We're the ones who are dealing with all this regulation, etc., on the ground with the consumer. Like, we're the ones who know the answers. So definitely make sure that we're participating in that.
I mean,
Okay, so
otherwise you end up with a loan application that doesn't have housing expenses on it, like we
oh
have.
my God, don't even get me
How did
started.
that happen? Because
I don't
none
know.
of us spoke it up and brought it up. We all missed that, went right
Well,
by.
and they kept pushing that out. It literally was pushed out years and we still missed it. So, phew. So Fannie Mae, in other news, approved 6 vendors for controversial new valuation initiative. And this is their statement. You ready? Fannie Mae last Wednesday updated its selling guide to include more options for property valuation, saying that the GSE is, and I quote, moving away from implying that an appraisal is a default requirement. Okay, so I kind of swing all over the place on this. Mostly I have my friend who is owns an AMC in my head, and he is part of congressional subcommittees, and him reminding everyone that collateral is at least, if not the most important, one of the most important components of a loan file. So are we going to play wild and loose with that? And while it seems great to not have to deal with appraisers, that's one thing. But the flip side of that, I mean, okay, to our appraisal friends listening in, I don't mean it like that. Good God, I just heard what I said. Although simple seems to be better, it isn't for the borrower a lot of times. Like, are they actually buying a place that's worth what they're paying? So for some borrowers, they want to know the answer to that. Is that going to be conveyed through these new systems? So we got to watch this. And it was funny because I picked up the phone and called a few people about this, and they didn't know it had happened. So because of that, we have very little information at this point, but we'll get some more. It's crazy. FHA just published that they have finalized the 40-year option as a modification option. So, and it's funny because when I first read the headline, I thought the FHA was coming out with a 40-year fix.
Yeah.
That would have been incorrect. So no 40-year fixed mortgage for FHA, but if you are in trouble, then maybe. All right. So I thought this was funny. I read this in Rob Chrisman's blog today, the Chrisman commentary, which we highly recommend. So today's Pi Day. Pi Day 3.14, right?
Yeah.
Okay. So he was pointing that out, and also that it's Albert Einstein's birthday today. So with that, he had a reader who chimed in and he said, I have an idea. His name is Matt O. I don't know who that is, but if you're Matt O, this made me laugh out loud. I have an idea. We organize a 10K race in San Jose and call it the bank run. That's funny. Why aren't you laughing? What is wrong with you? Good Lord. All right. I had like 15 different versions of the First Republic letter that I got saying everything's groovy. Don't worry about anything.
Actually, I do want to talk about real quick while we have a couple seconds, federal FDIC insurance and how it works. Because a lot of people have no clue about how it works. They all think, oh, it's up to $250,000. And it's not. It's much higher than that. Do you know that a couple together, it's $500,000
For each account?
For each,
I thought it was for each account.
People think it's by account. It's not. It's by how many accounts you have. So a couple, husband and wife, they don't have to be husband and wife, but joint tenants, they are insured for, they can have 6 accounts together. They can have a checking account, a savings account, and a CD. All right. They're going to take all those accounts together that they own jointly, and that goes up to $500,000. For an individual, you can have a checking account, savings account, and same thing, it goes up to $250,000. But if you have a individual account, but you have a beneficiary of one for each one of your kids, and you have 3 kids, that's another $250,000. So there's ways to insure all the money for millions of dollars in accounts. But it's just,
unless you have 27 children, you're not insuring millions. But okay, we get your point, and thank you. All right, I have more crap to cover, so let's keep going. All right, just wanted to quickly say that there were a couple of other banks that had failed. They were Silvergate and Signature Bank. They failed over the weekend or recently. And those were less of an issue because they were being used mostly as pass-through account or banks for liquidating crypto.
And one of them had Barney, the senator.
Frank?
Barney Frank. No, not Barney Frank. One from Connecticut. Bernie Sanders. Okay. Bernie Sanders. He was on the board. I'm like, he wrote the CFPB guidelines, and he's on the board of a
don't even get me
for
started.
A bank that went down.
Don't get me started. Okay. So bottom line is they're taking our deposits, they're investing them. If they're not investing them right, then the bank is SOL. That's it.
Oh,
Okay.
it was Barney Frank that was on the board. So
Oh, all right.
yeah.
All right. So
But he
listen
was
to
on the
this. So,
board.
okay. Okay. So we are going to have Dr. Elliot Eisenberg on the show in 2 weeks. He published this the other day, which I thought was really interesting. We are entering peak home selling season. The months with the highest premiums over asking price are March, 8.9%, April, 9.2%, May, 12.6%, June, 10.7%, and July, 10%. The 5 days when sellers are likely to receive the highest premium over asking price all happen during the 3rd and 4th weeks of May. 3rd and 4th weeks of May.
When I sell my
Lastly,
houses, 3rd, 4th, that's bingo.
but if you're a buyer, take heed. Okay, 5/23 is the day when the premium over list is topped at 18.3%. So I'm like, I'm reading this. I'm like, where does he get this crap? So I call him and I'm like, where did you get this crap? And guess where he got it? Wall Street Journal.
Yeah.
So anyway, I thought that was
I think
interesting.
they got it from me. I've been preaching that forever.
You're full of crap. You
There's
never broke it
pizza.
out like
Every
that.
year it's
Come
pizza
on.
at certain times. It just
Oh my
every year.
goodness. Louise. All right. So okay, there were a couple other things that I wanted to talk
We're
about,
over
which
time
is
now.
what?
We're over time.
Okay, just one more thing. So tomorrow there are 2 reports. It is, so what do we have today? CPI? Oh, okay, here we go. Tomorrow, PPI for February, that's wholesale inflation and retail sales. And just for the record, because Kevin loves this, CAS freight, the freight shipping costs, that just came down for the 3rd month in a row. All right. So to wrap up, which I don't know what just happened in the last 10 minutes, it just went poof and it's gone. We will have next week, we're going to have, oh my God, I don't even want to say his name out loud because I'm going to butcher his last name. He's a buddy of mine, so I can do that and he may kill me, but I'll be okay. Goran Stijasik. I know that's wrong. Anyway, it's with Cimarron Software, but he's a super smart guy. And we're going to be talking about systems and data. The week after that, we're going to have Dr. Elliot Eisenberg. And the week after that, we'll have Megan Anderson, who's NBS Highway. So we've got good stuff coming up. Share with your friends. Watch us on Facebook, not Facebook, YouTube. Mortgage Post 411. Thank you so much for joining us this week. Mwah. Bye, guys.
All right, bye, guys.